Yeah.
Alright, you're watching the earnings call right here on ET Now. IIFL came out with its numbers, PAT of 47 crores. The company reported was about 52 crores on a year-on-year basis. The total income figures will also flash on your screens. Kapil Krishnan, who's the Chief Strategy Officer of IIFL, joins us right here to give us a quick perspective on how things are shaping up for the company. What's the sense, Kapil? Thanks very much for taking out the time. But what's the sense, with the kind of drop that we've seen in profitability? I mean, how would you rationalize it? It's purely market forces which are coming to play?
Actually, our turnover has been quite robust in the year. As you know, the full year, the turnover went up almost 31% to 1475 crores, which is a good performance given the difficult times that the financial services industry is going through. And this is mainly on the back of a 111% increase in the financing income. Our loan book has doubled to 3,300 crores, and we also had a 43% growth in the distribution of insurance products segment, where though the API went up by just 13% because of a better product mix, we were able to get 43% increase in revenues there. The pressure has been more in the broking segment, where our turnover was down around 5%. And this is on the back of around 53% growth in the average daily turnover to 5,300 crores. And the revenue was down because, as you know, the F&O segment now constituted in Q4, it was around 90% of the market turnover compared to 76% in FY10. So because the F&O segment has a lower yield, there is pressure on the top line. And because of all this, our overall net profit was down around 9% to 211 crores for the year.
Okay, so how do you see the picture changing going forward, Kapil? What's the sense? Because like you said, broking revenues have been a drag. In terms of the revenue mix that the company has right now, how do you think that will change by the end of the same time next year?
Sure. We expect the similar trend that was there in FY11, which means that we will continue to grow our financing income very strongly. And broking revenues will depend on the way the market goes, but we don't expect a total reversal of the trend immediately. So we are doing what we can do. So we have maintained our market share despite increasing competition in the broking segment, which is at around 4%. And we are growing the loan book. And even in the insurance segment, we are doing changes in the product mix, which will ensure that our overall top line will be healthy.
Financing income, that's been an area of focus. You've highlighted the performance there as well. But the IPO market has taken a bit of a step back. In that sense, I mean, do you feel that in the coming few quarters there would be some slowdown in activity?
Actually, the IPO income is not a significant contributor to our financing income. It's mainly the consumer finance and loan against shares and margin funding. So the margin funding book would probably depend a lot on the markets, and we are basically growing the mortgage segment very strongly. And that is a longer term loan, so it's a better long term business as well.
So between the two, what is the breakup in the financing income segment, and how will that, do you think that breakup in income or revenue generation will change?
Yes, definitely. The capital market book will not grow as fast as the mortgage book, and we expect a much faster growth in the mortgage lending.
You want to put some numbers there?
Basically, I would not like to put a number on the next year's percentage, but for the current year, about 60% was from the mortgage segment, and around 35% was from the capital market segment. Going forward, we expect the mortgage segment to continue to grow much faster.
Okay, what about the current environment of high cost and credit? I mean, how do you see that impacting business overall, in terms of net profit margins particularly? How do you see it panning out?
Most of our loans can be actually repriced, and as you have been seeing with increase in the cost of funds, we are also going to increase our yields. So overall, we expect to maintain our NIM levels.
At what level?
They are in the 4 to 5% is what our target is, and which we expect it to continue.
Any fundraising plans, expansion plans on the broking front especially? I mean, are you looking at, enhancing your market shares? Like you pointed out, it's at about 4%. Is there a target that's being laid out for the future?
In broking, we are always trying to increase our market share, but there's so much new competition coming in with a lot of banks also wanting to enter the retail broking segment. As you know, Axis Bank also just entered the broking segment. So I think maintaining market share itself is a very good achievement, and it takes a lot of effort to do that, which we continue to do every day.
Okay, I'm also looking at the interest expenditure for the company, which is coming about 64 crores versus about 12 crores on a year-on-year basis.
Yes.
How will that picture change? I mean, obviously that's going to be a bit of a concern aspect.
Actually, it has increased a lot year on year, more because last year we were not leveraged, and this year's increase in the loan book has been funded by incremental debt. So going forward, the interest cost will grow in line with our financing income. So we don't expect to see this large increase in the current year.
But will there be repayments that are due in the course of this year? Because that's an overhang for the stock as well from an investor perspective.
No, debt repayments happen as a normal ongoing business process. That is not something.
But is there a target you want to reduce your debt position to? I mean, something to that effect, if you can highlight.
No. See, our net debt to equity ratio right now is about 1.2 times.
Okay.
So we have enough scope to grow our loan book by taking incremental debt. So we don't intend to raise any equity capital in the current year. And
but how much debt do you plan to raise? Is there a number that you have in mind?
We do have an internal number which it will grow in line with the loan book actually.
Oh, okay. Very quickly, given the scenario, Kapil, that there is in the market situation, it's very dynamic, and in some way or the other, it would be impacting each one of your business segments. An overall assessment of how you see things changing in FY12. Do you see as a whole year being a little more sluggish than FY11? Activity slowing down in all business segments. I mean, broking revenues we've already accounted for, but what about the other segments?
See, the demand for mortgage finance will always continue, and we find that is a very attractive segment because the repayment trends are also very strong. The NPA levels are low, and we can maintain a healthy NIM there, and that's more in our control. So we expect that the mortgage segment will drive growth in FY12. Overall, capital markets, as you mentioned, increasing inflation and interest rates will have their impact. But we are here for the long run, so these cycles will keep coming, and we will keep growing our business for the long term.
You also spoke about margin funding, a bit of a tricky spot in that sense, given the kind of volumes that we are seeing in the market and the volatility that we are experiencing. For the first quarter of FY12, how do you see the situation? I mean, we've already finished 1 month of it. How are things so far? How have things been so far?
Actually, the margin funding is just about 19% of our total book size. So as I said, we are shifting our focus from capital market lending to consumer finance and mortgage lending. So definitely margin funding will be dependent on the capital markets. There is no escaping that.
On the mortgage funding side, any specific strategies on how you're going to be pushing the product forward, how you're going to be expanding the business?
Yes, we have a large branch network, and we also operate through direct selling agents. So it's a mix of business sourcing, and we'll be expanding to other geographies as well and opening new branches, and that's how we'll be growing the loan book.
On the margin front as well, given the expansion plans that you have on the annual, on the expenses side, I mean, hiring costs, of course, expanding your employee base, how is that likely to pan out in FY12?
Yeah, I mean, costs are increasing because getting quality.
Also, competitive markets, you need to pay higher salaries.
You have to, and actually that is why the financing business makes a lot more sense for us to grow, because that's scalable, and so that's scalable, and for every incremental loan you don't have to add manpower. So the same person could do even 100 crores or he could do 10 crores. It's scalable. So that's why the growth in that's what's going to help in maintaining and growing the profits.
But on employee costs, are you working with some target, or how are you looking at controlling costs and still maintaining the quality that you would want, productivity?
Yeah, so as I said, once the top line grows with financing income, the percentage of employee cost will keep coming down.
Okay.
And that's where the profitability will increase.
Do you have a target? I mean, where is it today, and how much do you plan to scale it down by?
We do have internal targets, but let's just see as the year goes by.
So where is employee cost as a percentage of the revenue that you spoke about?
It's around 23-24% right now.
Oh, okay. And you plan to bring it down?
We expect it to be in control.
Be in control, okay. You're not going to be giving targets, I know, for FY12, but could you just give us a broad sense of the kind of growth you see over this year? I mean, maybe in a percentage sense, or how things would play out for the bottom line or the top line as well?
See, the average daily turnover in the broking segment went up by around 53% in FY11, and the yields came down. But now that the F&O segment is already 90% of total market turnover, we don't expect yields to come off much more from this level.
Okay.
And growth in the top line, I think, should result in better profitability as well in the current year, in FY12.
Okay, and Kapil, we wish you all the best for the future. Thanks very much for taking out the time and speaking with us on the numbers.
Thank you. Thanks for calling me.
Take a short break, but when we come back, address more numbers, more earnings, and keep it with the news.